Most investors spend most of their time on security selection. Which stocks to buy, which funds to hold, which sectors are positioned well, which individual positions will outperform the market. This is where the attention goes: the research, the analysis, the financial media coverage, the conversations among investors. And the research on what actually drives long-term portfolio outcomes consistently points somewhere else. Not at security selection, at allocation. The foundational research on this question was conducted in the 1980s and 1990s, examining what actually explained the performance variation across institutional pension funds over time. The conclusion was striking. Asset allocation, how capital was distributed across asset classes, explained the large majority of the variation in long-term portfolio returns. Security selection, which specific securities were held within each asset class, explained a much smaller portion. And market timing, moving in and out of asset classes based on predictions about direction, contributed almost nothing and was often negative. The asset class mix, equities, fixed income, alternatives, their proportions and relationships, was doing most of the work. Not the individual securities within each class, the structure of the portfolio itself. Why does allocation matter so much more than selection? Because asset classes behave differently from each other, in ways that individual securities within a class don't. Equities and bonds historically have moved differently in different environments. When equities decline sharply, as in recessions, investment-grade bonds have often held value or appreciated. When bonds decline, as in rising rate environments, equities have often continued performing. This relationship, not perfect, not consistent, but meaningful, means that a portfolio combining the two behaves differently from either one alone. Its volatility is lower. Its drawdowns during stress periods are smaller. Its recovery after declines is faster. The structural combination of asset classes produces properties that can't be replicated by selecting better securities within any one class. This matters practically because of how compounding interacts with drawdowns. A portfolio that declines 50% needs to return 100% just to get back to where it started. A portfolio that declines 30% needs to return 43%. The asymmetry of losses and gains means that limiting drawdowns through allocation has a compounding benefit that goes beyond simply feeling better during bad markets. It preserves more of the compounding base. It reduces the distance that needs to be recovered. It keeps more capital working through the recovery period. And more capital working through recovery compounds differently than less capital recovering from a deeper hole. This is why the investor who selects perfectly within a poorly structured portfolio often underperforms the investor who selects adequately within a well-structured one. The structure determines the range of possible outcomes. The selection determines where within that range you land. And the range set by allocation is wider than most investors believe, while the range influenced by selection is narrower than most investors assume. Most of the work is being done before a single security is chosen, by the proportions, by the asset class mix, by the structural decisions that determine how the portfolio behaves across different market environments. Security selection happens inside that structure. It matters, but it matters less than the structure it happens inside. Before this continues, if you felt seen instead of sold to, that's the entire point of Relentless Wealth. Like the video, subscribe. We're just getting started. Allocation is commonly understood as diversification. Don't put all your eggs in one basket. Own different things. Spread the risk. That's not wrong, but it's incomplete. Allocation, done structurally, is something more specific. It's the deliberate construction of a portfolio that captures different return streams with different risk profiles, and the balance between them determines how the portfolio behaves across different market environments. Every asset class has a return profile. Equities have historically generated the highest long-term returns, but with significant volatility and periodic severe drawdowns. Investment-grade bonds have generated lower long-term returns, but with lower volatility and typically better behavior during equity bear markets. Real assets, real estate, commodities, have behaved differently still, some providing inflation protection, some providing income, some with low correlation to both equity and bond markets. Each return stream has properties: expected return, volatility, correlation to other asset classes, behavior in different economic environments. Allocation is the process of combining these streams in proportions that reflect the investor's time horizon, their actual risk tolerance, their need for current income, their behavioral capacity to hold through volatility, to build a portfolio that behaves the way the investor needs it to behave. The proportions matter enormously. A portfolio that is 90% equities and 10% bonds will behave very differently from one that is 60% equities and 40% bonds, not just in returns, in the experience of holding it. The 90-10 portfolio will likely generate higher long-term returns. It will also experience larger drawdowns, deeper declines during recessions, more volatile periods that require more behavioral discipline to hold through. The 60-40 portfolio will likely generate lower long-term returns. It will also experience smaller drawdowns, a smoother ride, less behavioral pressure during market stress. Neither is objectively better. One is better for a specific investor, with a specific time horizon, a specific behavioral capacity, a specific set of financial needs. The allocation is a structural decision about what kind of portfolio that specific investor can actually hold and hold through to the destination. Return streams also interact with each other. The correlation between asset classes, how they move relative to each other, is as important as their individual properties. Two asset classes with high expected returns but identical return patterns that both decline in recessions and both rise in expansions don't provide meaningful diversification. Their combination produces a portfolio that behaves like a larger version of either one alone. Two asset classes with lower individual returns but low or negative correlation that move differently across market environments produce a portfolio with properties neither has alone. The combination is more than the sum of its parts. The portfolio behavior is a function of the correlation structure, not just the individual return profiles. This is where most individual investors make allocation errors. They focus on the expected return of each individual holding. They add holdings that look attractive in isolation. They build a portfolio that looks diversified from the outside, many different funds, many different tickers, but is concentrated in practice. Because many of the holdings are highly correlated, they behave similarly in the same environments. What looks like a diversified portfolio functions like a concentrated one when the market moves. The structural work of allocation isn't about the number of holdings. It's about understanding how those holdings interact across different environments and whether the combination actually produces the portfolio behavior the investor needs. Most investors treat allocation as a one-time decision. You set the portfolio, you select the proportions, you move on. And that approach, without what comes after it, produces a portfolio that drifts away from the intended allocation over time. in ways that change its risk profile without the investor realizing it. Here's how portfolio drift works. An investor starts with a 60-40 portfolio, 60% equities, 40% bonds. Over the next 5 years, equities significantly outperform bonds. The equity portion grows as a percentage of the total portfolio. Without rebalancing, without selling some equity and buying more bonds, what was a 60-40 portfolio has become a 75-25 portfolio, or 80-20, or more. The investor didn't intend to change the allocation. They didn't make a decision to take more risk. But the portfolio's risk profile has changed significantly through market movement alone. And the investor is now holding a different portfolio than the one they thought they had. Rebalancing corrects the drift. Periodically, annually, or when allocations have moved meaningfully from targets, the portfolio is brought back to the intended proportions. Selling asset classes that have grown beyond their target allocation, buying asset classes that have fallen below their target. Structurally, this is selling what has risen and buying what has fallen, which is the opposite of what emotional investors do, who buy what has risen and sell what has fallen, and which has a meaningful effect on long-term outcomes, not because it generates alpha, but because it maintains the intended risk profile and enforces a form of systematic discipline that most investors can't maintain behaviorally. Rebalancing also has a behavioral function. The investor who rebalances has a structural reason to act during both rising and falling markets that isn't driven by fear or greed. When equities have risen significantly, rebalancing means selling some, taking some gains, reducing the equity overweight. When equities have fallen significantly, rebalancing means buying more, adding to a declining position, restoring the equity allocation. Both of these actions are counterintuitive. Both of them are structurally sound, and both of them produce better long-term outcomes than the alternatives, which are chasing what has risen and fleeing what has fallen. The rebalancing discipline isn't about generating excess return. It's about maintaining the structure that was doing most of the work before any selection decisions were made. The investors who build strong allocation frameworks and maintain them through rebalancing consistently across market cycles don't necessarily beat the market. They do something more useful. They hold the structure that captures the return of the asset classes they own without the behavioral drift that converts their intended allocation into something they never chose. They stay at the allocation level where most of the outcome is being determined, instead of chasing returns at the security selection level where most of the effort produces less impact than most investors believe. The portfolio's structure was always doing most of the work. Rebalancing keeps that structure intact. And the discipline to maintain it through rising markets when selling feels wrong and falling markets when buying feels wrong is the behavioral work that most investors are unwilling to do consistently, which is why the research finding remains persistently underutilized, even by investors who've read the research. If this shifted something for you, subscribe. Like this if it clarified something.